Good afternoon, everybody, or indeed good morning or good evening, depending where you're joining us from. I'm Niccolo Poli, the CEO of HSBC Luxembourg, and it's my pleasure to welcome you to the first e-conference of ESG Squared, where we're going to talk about how green is my green investment. I'm going to make a bit of a slow start to allow time for people to join in. I know we started quite promptly. We are also trying out a new format today with our media partners here. We're trying something quite snazzy and open to broader participation, since we are hoping that people will be joining us from many different places. I would welcome feedback on this, so we're not doing the typical sort of Zoom meeting, but again, it allows greater participation, everyone to access via the website and draw people here, but perhaps not as real-time interactive. So your feedback is very welcome, again, via the website would be perfect. HSBC Luxembourg started this initiative earlier this year called ESG Squared with the attempt to, or the desire really, to raise awareness, promote awareness around sustainable finance and what is happening in this space. And we've taken some of the leading actors, and if you've visited the website, you've seen we've done quite a few interviews. We've also got numerous publications. And I think we've had a very good start to this. Two things have become very clear from all of the initiatives we've done over the last few months. The first is that sustainable finance, ESG, call it what you will, is really taking off. And there's more and more people talking about it, and is really becoming key for the finance industry and beyond. The second thing is there's a very clear concern around how real is this and how much of the money is going to go into real sustainable financing and what is the real impact, because at the end of the day what we're trying to do is mitigate climate change. So how much of that is really doing this and how much is not entirely as green as it could be, and where's the data to substantiate this? So these are some of the things that we've realized, and that's why we decided for our first e-conference just to go straight to the heart of the matter and tackle it and talk about how do we know that an investment is green, how can we measure that, and how can we ensure that it remains green over time. We have a fantastic panel representing a very good panoply of actors in the ESG Square. So we have Julie Becker from the Luxembourg Stock Exchange. We have Xavier Desmadrilles from HSBC representing obviously a large global bank with very big ambitions in this space. We have Patrick Uribe Wood representing a fintech, if you like, a disruptor or someone coming in to help measure the impact that we really make and keep us all honest in this space. And we have Denise Voss, the chairwoman of LuxFlag, a labeling agency, a very well-known labeling agency in Luxembourg. Unfortunately, she was not able to join us live, so we have a recorded video with her, which we'll share after the panel. So I think we've done our little intro. Hopefully people have managed to join. I'm going to start with the panel session. Instead of me, I think, introducing everyone, I will ask you to introduce yourselves, because I think you probably do a much better job than I would. And as they say, ladies first. So Julie, I am going to start with you, if that's all right. And perhaps you can give me a brief introduction to yourself and to the Luxembourg Stock Exchange.
Good afternoon, Niccolo. Good afternoon, all. I'm Julie Becker, the CEO of the Luxembourg Stock Exchange and the co-founder of the Luxembourg Green Exchange, or LGX, the world's leading platform entirely dedicated to sustainable finance. LGX has been created back in 2016 as a contribution to the UN SDGs and the Paris Climate Agreement. Our aim was to unlock sustainable capital and redirect capital flows towards sustainable development projects. All began with green bonds only, then the platform was extended to social and sustainability bonds in 2017, to SRI funds in 2018, and to sustainability-linked bonds last summer. More recently, beginning of 2021, we also added a new issuer section on LGX to display the bonds issued by climate-aligned issuers, or issuers that derive at least 75% of their revenues from environmentally friendly activities, with the objective to expand the scope of sustainable investment opportunities for investors. And to end, we recently celebrated the 1,000 sustainable bonds on our platform for a total amount of 500 billion euro today, coming from 170 issuers in 35 different countries, which means a truly international reach.
So very, very impressive numbers in not such a long period of time, and I'm sure they'll continue to grow exponentially from here, seeing the activity that I've witnessed. Can you briefly take us through what's the difference really between the Luxembourg Green Exchange and the normal Luxembourg Stock Exchange, and are there different qualifying criteria, or why did you find it necessary to co-found the Green Exchange?
Well, as said, the Luxembourg Green Exchange, or LGX, is a platform entirely and exclusively dedicated to sustainable finance instruments. The sustainable bonds on LGX are issued according to recognized international standards like the DBP, SBP, SVG, or SLBP from ICMA, the International Capital Markets Association, so best market practices, or climate bond standards from Climate Bond Initiative. And issuers commit to extensive pre- and post-issuance reporting so that investors can verify that issuers deliver on their commitments. So if you compare this to our traditional markets, there is an additional level of transparency which is required in addition to the financial documentation required by prospectus or transparency regulations in Europe. And all documentation, so the Green, Social, or Sustainability Bond framework, the second opinion or ex-ante external review, prospectuses, and post-issuance reports in particular, are made available for free on our website. LGX offers the highest level of transparency, and our teams monitor that issues deliver on their commitment and provide us with the post-issuance report.
So then it's the Luxembourg Stock Exchange as well that monitors the adherence to this and ensures that the listings are indeed green and remain green over time? Or did I understand that correctly? Is that something that you do, or is that outsourced to another party?
It's done completely internally, but we are not judging. We are just monitoring that the issuer deliver on its commitments and on its transparency commitment, which means that it commits to provide investors, to report to investors about its investments, and investors then are allowed to check whether the funds that have been invested in the bonds are well allocated to a dedicated and specific project, and potentially also the impact that has been created as promised from the beginning. What we are monitoring is that the process is followed and the post-issuance report is released.
Got it. And so that's how you ensure that the bonds that are listed on the Green Stock Exchange are green and indeed remain green or remain adherent to their commitments.
Absolutely. And by doing so, we had created like an exchange standard, which is, by the way, becoming the EU Green Bond Standard that could be endorsed by the Commission in the coming months.
Super. Thank you very much, Julie, and welcome. Moving on to Xavier. Perhaps you could give a brief introduction to yourself and what you do at HSBC.
Sure. Thank you, Nicolo. I'm Xavier Smadril. I'm the Global Head of ESG Research for HSBC Global Asset Management. HSBC Global Asset Management is quite obviously the asset management arm of HSBC Group. And we have more or less 620 billion US dollars assets under management. And we manage money across the 5 continents. We have, let's say, more or less 2,000 staffs, and we cover basically all asset classes. And it's fair to say that we have a long-standing commitment to sustainability because our ESG story or journey started back 20 years ago, more or less, with the launch of our first SRI funds in Paris. And since then, this has been quite a journey, sometimes a bumpy ride, I must admit, but still this has been quite a journey. And today we have gone for full ESG integration, meaning that more or less the 600 and something assets under billion US dollar assets under management we have, on board some amount of, let's say, ESG integration, meaning that those environmental, social, and governance criteria will be taken into account into our investment decision. And we do so because we have a core belief that this can add value to our client, i.e. that it can help offering us better risk-adjusted returns over the long run. To be specific, I wouldn't dare saying that we apply ESG integration to 100% of our AUMs, but I would say more cautiously that this applies to 90% more or less of our assets under management. The difference between 100 and 90%, if you are good at maths, is 10%, and those 10% correspond more or less to some alternative asset classes, for which it's fair to say that we still struggle to find ESG data. And this is why we are kind of busy developing on processes in order to make sure ESG is also onboarding. Just to give you a couple of examples, we are talking about infrastructure debt. We are talking about, let's say, alternative investments. We are talking about other kinds of alternative investments. And last but not least, we are also currently developing a range of natural capital products alongside our partner Pollination, with which we have developed a JV. So you see something which is quite comprehensive, already dating back to 20 years, so a pretty deep experience in this field. So we are not newcomers, and we think that this is a secular trend, we are there to stay, and this theme is there to stay, and we will progressively apply this to all our AUMs.
Brilliant. And I must say, there's been a loud bell gone a few times, and you haven't missed a beat. So congratulations, your media training is really superb to not have been distracted. I, on the other hand, couldn't help but mention it. So there you go. I need to go back and do some
it's an old clock, which is within my dining room. It's very noisy. Sorry for that.
Oh, no worries. Good. As we speak about it, you've given quite a comprehensive overview. It is a very large, global mandate that you're operating on. Could you just take me a bit more through how do you really ensure that they are green and that these investments remain green over time? You've talked briefly about the ESG criteria, but how do you sleep well at night knowing that you're really doing a positive impact to the world? Yeah,
I would summarize it by saying it's the show me the money part of things. But because saying you are sustainable is fine, demonstrating it is certainly better, if not compulsory. And how do we do that? Actually, by reporting on this, by, let's say, showing our clients that we have, for instance, a higher or better carbon intensity than the comparable benchmark, by proving able to evidence the fact that we interact with companies. As a British company, we are very fond of stewardship, i.e. voting and corporate engagement. And we do this because this is a good way, interacting with companies is a good way to convey the right messages. For instance, in the oil and gas sector, it's fair to say that we have been pretty active supporting shareholders' resolution, urging companies to report on their, let's say, carbon footprint. It might sound obvious today, but believe me, to some US companies, sometimes it's not that obvious. This needs to be explained. And this is why we have supporting 3 years in a row shareholders' resolution, asking those companies to, one, take carbon into account, second, to report on it, and three, to have a proper mitigation strategy in place. Those are typically the kind of things we have to do. It's very much about advocating, reporting, communicating, and this in the most transparent manner, which is anyway something which is currently asked by the legislator, and this in many, many places. As you can imagine, we are exposed to European legislation, but also to legislation in other countries, like, for instance, Hong Kong and Singapore. And Julie was referring to listing requirements. Believe me, listing requirements in these remote places are, let's say, catching up. Meaning, if you want to be listed in the Hong Kong Stock Exchange, you have, again, to show your green credentials and to report on them in a very transparent and rigorous manner.
You raise a great point here, which is, we were speaking of Luxembourg, but obviously we operate around the globe, and there are very different standards when you look at different markets. You wrote a very good piece for ESG Squared on the use of AI and data. Could you tell us a little bit about which data sources you use? How do you employ these techniques in your day-to-day job?
Sure. Let's say that when you use AI, i.e. artificial intelligence, is very much about filling the gaps. Because when you want to get or you want to gather ESG data, which are absolutely compulsory if you want to have a kind of holistic understanding of each and every single, let's say, holdings, underlying risks and opportunities, if you want to have this comprehensive vision, you need to reach out to the ESG data vendors. And there are many out there. Some of them are really famous. I could quote MSCI, I could quote Sustainalytics, I could quote also some specialized carbon data vendors like S&P TrueCost, just to name a few. But sometimes you see, you end up discovering that there are loopholes in their coverage, simply because it's sometimes quite difficult to cover some, let's say, markets, some segments. And just to mention two, we have always noticed that emerging markets coverage is certainly insufficient, and also fixed income coverage is similarly insufficient, especially if you consider high yield. And unfortunately, as a global player, we've got a very strong footprint in emerging markets, and we are also more a fixed income house than an equity house. So if we want to be credible, we need to develop a coverage for these market segments which are not that well covered by the traditional data vendors. And then it's fair to say that AI can be very helpful because it's currently framed around algorithm. And the beauty of algorithm is that, yes, they are abstract, but they are also very flexible. And so you can really tailor them to your needs. And so you are proving able to fish the information you need where it stands in this or that obscure part of the internet. And for instance, when it comes to covering Chinese companies, we are currently developing a partnership with a local player, a local fintech, once again, who has developed a clear expertise in trying to assess Chinese companies' ESG quality. Because when you interact with the traditional data vendors, they always claim that they will cover this or that market segment. But when you, let's say, try to look what's under the bonnet, you soon discover that there are definitely some loopholes. Simply because, and it's kind of a tip of the iceberg theory, generally they focus on the 10% which are emerging at the surface of the water, i.e. the information which is labeled in English. But unfortunately, when you are dealing with Chinese company, information is either in Mandarin or Cantonese. So when you don't develop techniques enabling you to grab this information through having, let's say, NLP, natural language processing, or machine learning or deep learning, which are the three main, let's say, artificial intelligence technologies. And when you don't have the capability to, let's say, activate them in those local languages, you miss the point, you miss the information. This is typically why we are currently engaging those kind of fintechs in order to really to gather the information we need for the segments we need, which are not that well covered by the others.
Fantastic. Xavier, I think you could probably teach a course on this because I sense there's a lot of history and experience there. And I think it's also a perfect lead-in to Patrick. So Patrick, perhaps you can introduce yourself and UTIL quickly.
Yes, absolutely. Well, thank you, Nicolo, and Yes, hello to everyone who's joining us. It's a pleasure to be here. So I'm the CEO at Util. We actually, to build on exactly what Xavier was talking about, we use machine learning to measure how companies contribute to the UN Sustainable Development Goals and about 2,000 further sustainability topics. And to speak to Xavier's point about coverage, we cover 45,000 companies. That's every listed equity in the world. And actually, to offer a little bit of context, I'd say that we really sort of bring together these strands of AI and ESG. Both are becoming increasingly important. And in our case, they are actually very closely related for the reasons that Xavier points out, which is to do with the coverage and also how we access data and how we manage to kind of understand these companies better. So we know that the demand for better information, particularly about the sustainability issues and the non-financial impact of companies, that demand has exploded. And it's because investors really want to align their investments with their values, but it's a really manual process to deal with that kind of data. And it means that either it's done very well if you do it manually on a small scale, or if you try to do it on a large scale manually, it usually goes very badly. And so that's where our technology is designed to help. And we use AI to draw out the appropriate evidence from about 120 million high quality text sources so that we can provide investors with trustworthy evidence-driven data that works at scale. There's one other component that I think speaks to the transparency aspect that Julie was alluding to earlier, which is that we look at what I would call the heart of the business, since we look at the revenues that companies generate from what they sell. So we offer a kind of new dimension or a new angle when it comes to understanding understanding the impact of companies on the world, because we're looking at the things that they sell, the kind of things that leave their doors and go out into the world, rather than looking at their internal operations. And that gives us a very different perspective on those companies.
Super. And what do you think about the data providers that Xavier was mentioning, the data used, and what you've heard in general? Where are we on the evolution, let's say, from nascent to well developed in terms of being able to really measure impact? What are your thoughts on that?
Well, I think it's very interesting, because I think this brings together a couple of different strands that we've talked about, that both Julie and Xavier mentioned. And I think the ESG providers that are out there, I think one of the principal challenges is that the methodologies are very different from one another. And so it means that, for instance, we might take a particular company. For one data provider, that will be ranked number 1 out of 12 in their industry. But for another provider, it might be ranked number 12 out of 100 in a different labeled industry. There'll be different criteria depending on whether the E counts more highly, or S counts more highly, or G counts more highly. So it's very, very difficult for investors to really understand kind of meaningfully how to kind of navigate these different data sets. And I think one of the really important things that we're trying to do at Util, but I think is broadly a really important thing in the market in general, is to figure out how to make sure that new information is genuinely new and genuinely valuable. I think where there is disagreement between providers, that can be very fruitful, because, for instance, if we look at let's take a really easy target, a tobacco company that has great sustainable farming practices. That's one dimension of that business, which is totally fine. But they do also sell tobacco products with known very harmful health effects and all of those different things that are not captured in their internal operations, but we capture them in the product side of what we're offering in Util's data. And those two things put together allow investors to understand, well, do I care more about labor relations, or do I care more about the health impact of tobacco? And they can make that decision based on that new information. Whereas I think if it's just sort of competing methodologies that don't add new information, I think it does a disservice to investors in the end.
Got it. So if I understand correctly, one of the issues you've identified is that there's volatility in this. So you could look at the same company and either conclude it's very green, medium green, or not very green, depending on the different weightings and algorithms that are utilized. And if I've understood again, what you do is you're providing greater information or greater transparency in terms of the weightings. So do you actually say this company's green or not green, or do you say it's green in these elements and less green in these others? What does Util actually do? How do you increase confidence?
That's a great question. So, so there are a couple of different things. The way that our data specifically works is that we actually map the revenues that companies make through their products in a one-to-many mapping. So we map those products against all of the SDGs, both positively and negatively. So we capture the trade-offs that are happening. So we don't take, for instance, a healthcare company. We don't just say, oh, that must be good for health because it's a healthcare company. What we capture are things like certain types of healthcare company have a great many single-use plastic items, medical devices that can only be used once, like syringes, for instance, that we actually capture not only the positive health effect of that, but also the negatives when we map it against, for instance, responsible consumption and production, which is SDG 12. So we capture these sort of multiple impacts all at the same time. And I think one of the important things is that we can use this as a way to kind of triangulate the existing data sets that are out there. I think that's a very important thing for investors to be able to do, is sort of understand and manage these various different trade-offs as they think about their investments and their impact on the world.
And that's what it is at the end of the day, is providing the investors the information to say, I want to invest more in clean water or in education or in other things. And I think that's what you do. I won't ask you to name all 17 SDGs, but I think you could probably do it. I've got confidence in you in that. Look, thank you very much for the introduction. I'd like to open it up with a couple of questions now to the panel, to all of you. We have mentioned SFDR. It is a regulation that has come into act, and it is starting to be adhered to. What is the role of regulators in terms of promoting ESG in your minds? Are they helpful, or is it a hindrance and the market should just manage this on its own?
Actually, people often see regulators as a constraint, but actually I think they are actually leading us in the right direction. Let's take the example of SFDR. It's also nicknamed the anti-greenwashing legislation because it's urging us, again, to walk the talk, meaning that we have clearly to demonstrate, to evidence the fact that ESG is actually onboarding, which is a good thing, because if we are serious about that, if we want to have a positive impact, we have to do things seriously. But let's be clear, for us, this is a constraint because we need to develop, let's say, new reporting tools, we need to develop new practices. This requires sometimes some pretty hefty IT developments and related investments. But I think it's clearly leading us towards the right direction. Then people can argue, yes, but the legislator is too picky in here, not picky enough in here. With this, I won't disagree, but still, I think they are showing us sort of a direction of travel. And it seems to me that the direction of travel is not pretty clear. So we need to adapt, and this will happen progressively. Now, if there was a caveat to this kind of blue sky thinking, like the background I've got behind me, I would say that sometimes the legislator is putting the cart before the horse. Let me just give you an example. Everybody is interested about biodiversity. And this is a fair point. Biodiversity is very important. And we are asked by some legislators, it's the case within SFDR, it's also the case in France with our world famous Article 173, we have to report on biodiversity impact. Yes, brilliant, fine, love to do it. But the data are simply not existing. So we can use those marvelous AI techniques, which I have alluded to and which Patrick has described with much more detail than I have. But is this sufficient? Question mark. And I think that the legislation would have been better off asking first the companies to report on those dimensions instead of urging the asset manager to report on that, in order also to put pressure on the investing companies and make sure that they take the right steps. In my views, doing things the other way around, first asking companies to report, and second asking asset managers to report, would have been probably better. But here we go. That's the decision they have taken, and we need to live with them. This is why we have to be creative, create new data set, partner with some data vendors, which are also urged to be quite creative and to be quite serious about what they are doing. And I think this is clearly stimulating creativity in many areas. This is at the least what we are experiencing within HSBC Global Asset Management.
Very good. So the view from a global bank. Patrick, I think I interrupted you at the beginning. What are your views on this?
Well, I was actually going to say, it looked like Julie had something to say as well. So I certainly don't want to steal her thunder. So Julie, would you like to go first and then I can?
No, go on, Patrick. It's fine.
Okay, well, thank you. I was going to say actually something very, very similar. One of the things that strikes me about there's sort of always a tension between this idea that the market can take care of itself and the idea that regulators need to sort of intervene in the market. And I think one of the key things is that the regulation should really address what I see as probably the single most common problem with markets that don't work well, which is when information is not equal on both sides. So if you have information that is transparent, if you force companies and, in Julie's case, if you force, listed securities, you make sure that there's transparency around both the kind of pre and post kind of listing moment. That's something that helps investors make those decisions and kind of makes the market more efficient. And I think that's the direction where regulation is really helpful, because in fact, otherwise, the markets we already know, they don't really take care of themselves. They're immensely powerful when they're deployed right in the right way, but they do need a kind of top-down guidance that I think just sort of sets the parameters and sort of it's almost like the lines on a football field, where you know that the ball is in play when it's within these lines, and that's where the regulator really helps, but they don't really sort of get involved in the game itself.
Thank you. And Julie, what are your views?
Yeah, I completely agree with what has been said so far. But at the end, I think it's always a question of finding the right balance between encouraging actors on the transition path to avoid stranded assets and to ensure the stability at the end of the financial system, and also ensuring the integrity of the market. Indeed, as Xavier was mentioning, it's clearly the role of regulation, of course, is to avoid and reduce at least the risk of greenwashing. Brings clarity and certainty, and we see that with the EU taxonomy and SFDR, which helps in defining sustainable assets and sustainable investments. So sustainable finance regulations are clearly an important driver for change, and they also because they put investors' protection really at the core. They require that investors are asked for their sustainability preferences, and that they are presented with financial products that meet those preferences. And regulation also help standardize metrics. For instance, we see the level 2 of the regulation, which foresees the enforcement of 18 metrics as mandatory for funds that are considering ESG factors. This is really something very, very substantial. But we still have lots of obstacles, as Patrick was just mentioning, especially because we still lack of comparable, science-based and auditable data to produce mandatory disclosures. The costs to comply, of course, are not at all negligible. And the main challenge as well is about regulations that are interlinked or asynchronized, as it was just mentioned by Xavier, for instance, between CSRD and SFDR, where at the end, indeed, companies will only begin to disclose when investors in those companies will need to report on those disclosures. So this is the main challenge. But a last word, which is also interesting maybe to underline, is the difference of culture between China and Europe, where you see that in China, it was really a top-down approach, because it was already back in December 2015 when the Green Bond Catalog, the first version of the Green Bond Catalog, was released. So really a top-down approach While in Europe, it was exactly the contrary, a bottom up, with really the market embracing ESG before it was even shaped by the European regulator.
Very good. So I'm going to summarize that as a good start. Anti-greenwashing is probably a good way to start and a good place to start in terms of increasing people's confidence to invest. But clearly, still room for improvement, presumably, on this. Now, linking into my last question, and I think we've only got a few minutes left, unfortunately, but if we look at Luxembourg is really trying to position itself, sort of as a green center, as a hub for green investments, and clearly, Julie, with the Green Stock Exchange, that's been a great start. What more do you think Luxembourg should be doing in this space to really become a green fund investment finance center? And Julie, maybe we'll start with you, and then Patrick and Xavier, you can add on to that.
Well, I think we need to be ambitious, which means also being courageous and understand and assess where we, at least the financial industry, stand today in terms of exposure to climate-related risks. I think this is really key to ensure the stability of the financial system in the future and to anticipate the stability of the financial center. So a great initiative is the Luxembourg Sustainable Finance Initiative, which is a not-for-profit association aims at implementing the sustainable finance strategy of the Luxembourg Financial Center. And what is the most important is that they plan to collect and analyze data on the Luxembourg financial industry in order to measure and follow its progress in integrating sustainability. But an idea I would have to for Luxembourg to be more competitive is, for instance, the introduction of a new law similar to the former Luxembourgish Loi Rau, I don't know if you know it, which was providing fiscal incentive investment to encourage retail to invest in risk capital or stock market with a tax deductibility for the invested amount within certain limits, of course. But the objective is clearly to encourage savers in Europe to invest their money in long-term, low-risk investments and guide them towards sustainable investment, which would also provide at the same time the objective of securing their pensions while contributing to the real economy and the sustainable development.
Some great ideas there. Patrick or Xavier, would you have other thoughts to add on to that around Luxembourg? I know neither one of you are actually based here, but great to hear your thoughts on how to become more competitive and attract even more of the green finance.
Well, I can
Go on.
I can be very brief, actually, because I'm the most distant from Luxembourg, but I've had a lot of interaction with Luxembourg lately, and I think one of the key things that I've seen so far, and that it's more that I would encourage this to happen more often, is a willingness to sort of embrace these new ideas and to really think ambitiously about where Luxembourg can go. I think that's the key thing, is to think big. And to take very, I think, courageous and calculated risks that advance this particular agenda. So that's my one addition is sort of more of the same, because I think it's already working quite well.
Super, and it does start with ambition. And Xavier, maybe just the last few words from you, or thoughts on this.
Last few words from me. Well, regarding Luxembourg, or more generally speaking.
As you wish, but the idea was just around making Luxembourg more competitive, given that most of our audience would be here.
Well, as an outsider, but with many funds domiciled in Luxembourg, what we like is clarity and transparency, and also stability. And so if there are clear rules urging us to embed ESG into our fund management, this is fine. Even if there's a constraint, that's not a problem. We will adapt to the constraint, but as soon as the constraint is making sense, helps us delivering better financial outcomes for our client. And talking about outcomes, you have mentioned impact. Something we will be looking at is maybe some more clarity coming from the legislator in terms of a definition of what is an impact. And still, I must say that things are pretty vague, because it will be extremely helpful for clients to get to know what is not only the financial outcome, but what is also the social, environmental outcome of their fund. And this is why we are working alongside some providers in order to develop what we call 2.0 metrics, such as avoided carbon, for instance. Because if you invest in companies, if you invest in an equities portfolio, and you tend to discover that it contributes to avoid XYZ tons of carbon, I think you are better off. You have something concrete, and I think you have something clients can cling to, and therefore I think everybody's much better off. So this will be, let's say, my suggestion. Super. Let's work together on defining more precisely impact, because this will help, let's say, the cause and also help the clients.
I like it. Clarity, transparency, stability. So look, thank you very much. I think this concludes the first part of the e-conference, which is on the panel. Thank you for your contribution. Please stick around. We're going to go now to a pre-recorded interview with Denise Voss, because she was unable to be here on the day. We'll do that, and then we'll come back to wrap it up. Thank you very much. Denise, thank you so much for joining us for our first e-conference for ESG Squared, entitled How Green is My Green Investment? Could we start perhaps with a brief introduction of yourself and then also LuxFlag?
Thank you, Nicolo, and thank you so much for the invitation to present LuxFlag. Well, I've been in Luxembourg now for almost 31 years, and all of that time working in the fund industry. And I've had a chance actually to see how Luxembourg has become really a leader in sustainable finance. And one of the pieces of evidence of that is LuxFlag. So I'm here today as director and chairwoman of LuxFlag. LuxFlag was created in 2006 by public and private partners as an independent labeling agency. Its goal is to promote sustainable development and promote transparency as well. So a LuxFlag label is given to investment products that comply with the criteria of the labels, and basically shows that those products do what they say on the tin. So we have 5 labels, 2 different kinds of labels. One label, our most popular, is the ESG label, and that's really all about transitioning to meet climate change goals and other social goals. And those funds will need to comply with the Sustainable Finance Disclosure Regulation, or SFDR, Article 8. Then we have 4 labels which are about impact, and the investment products that get those labels are about positive impact. This is what they seek, and they comply generally with Article 9 of the SFDR. We also have a very active associate membership program and a sustainable knowledge center. And in terms of, last but not least, statistics, so we have 347 labeled investment products today with assets under management of 150 billion euro. Asset managers and actually other managers from 17 countries. So really demonstrating how international LuxFlag is.
I didn't realize it was 2006. I mean, that's quite a while.
Early days.
Ago, so early days. So now really the flood, it feels like it's truly coming. Could you take me through perhaps the labeling process? How long does it take? You know, what data do you require? Just how intensive is it?
So we have a quarterly application process, and generally from the time at which the application is submitted to when the label is granted, that's 3 months. The label is good for 12 months and can be renewed for another 12 months and 12 months after that. So we have a very robust review and governance process. We have, once the application is received, the LuxFlag team reviews the application, passes it on to our general manager, Sachin Bankalas, who reviews it at his level, and then who also then provides a recommendation to our eligibility committees. So we have an eligibility committee, which is an independent pool of industry experts, different committee for each label, and that they also review the applications and provide their recommendations finally to the LuxFlag board of directors, who give it a thumbs up or a thumbs down in terms of granting the label. There's a lot of data and information, not surprisingly, required of the applicants. It depends on the label, which label and the criteria. However, legal documents are always required, so that's prospectuses, financial statements, and the like. Then we require basically a description of the investment policy, other policies, ESG, exclusions, engagement policies, and the like. We require the applicants to demonstrate how they use ESG strategy and criteria in the investment process. And we require that they give us their portfolio of investments so we can validate actually that the portfolio meets the criteria of the labels. The cost of the label is 3,000 euros per year, and that's per sub-fund when we're speaking about investment funds. And then that whole process is certified by ISAE 3000.
Okay. So there seems to be quite a bit of data that you gather. Some of this will be audited, clearly, the financial statements and others. Some of it might be a bit more self-declared. What checks do you do on the data? Because we've been talking a lot about the quality of data being a key issue in all of this.
Well, I mentioned that the review process is quite robust. There's a report that's prepared for every applicant by the LuxFlag team. We do use the data from the applicants, but we do also use third-party data to validate actually what the applicants are telling us. The checks actually depend upon the label. So for instance, for the ESG label, we would, amongst other checks, we would be checking the portfolio to see if there are any controversial companies who are entering into controversial activities or sectors. And another example would be for the climate finance label. We would actually validate that there's a direct link between the investment activity and climate adaptation or climate mitigation, for instance. And we use third-party data in many of those instances.
And have you ever had to delabel a fund or parts of those investments, or change your opinion on that?
Yeah. Well, hopefully this doesn't happen, but from time to time we have had some applicants where we have, in the review of the portfolio, we've identified a company that is on a controversy list in terms of significant harm to the environment or to local communities. And in those cases, we will certainly, LuxFlag will engage with the applicants, of course. In terms of the review process, if the rest of the process is complete and fine, we might decide to put a hold on that application, or we might decide to grant the label, but on the condition that that controversial company is sold out of the portfolio.
Okay. I mean, of course, no one ever wants it to happen, but I think it's important that it does and that it can.
Exactly.
Because I think it's what gives the guarantee of quality to the label, the fact that it is always being refreshed and reviewed with that optic.
Exactly, and I can actually mention one thing we have done, maybe on a bit more of an informal basis, but are now putting into place formally, is a 6-month review of the portfolios of the labeled funds to ensure, again, that there are no controversial companies in those portfolios, etc.
I think that's important for investors.
Yeah, exactly.
Because they want to know that this is really happening, and it's
exactly.
Like you said, it is what it says. It does what it says on the tin.
Exactly.
Another question for you. So much like all firms, we're constantly looking to improve, what we do and how we offer products and services. Can you take us through LuxFlag and how? What's the journey been to date, if you like, and where is it going?
Well, the journey to date over the last couple of years has been about extreme volume, I would say, and trying to keep up, in terms of having resources on the team. But now we have a great team, and I think we're in good shape. But we have had 77% growth over the last 12 months in terms of the volume of labels, not applications, but labels granted. So this is a good problem to have, of course, but we are focusing quite a lot on automating or digitalizing our application review process as much as possible. But we also want to do that to try to enhance the user experience as well in terms of automation. Another area is the increasing, quality for the LuxFlag label, as you mentioned earlier, is primordial, basically. And so we are actually focusing quite a lot on getting additional third-party data to help in the validation process. And as I mentioned earlier, also our 6-month portfolio review process. So really, automation and then third-party data to enhance the validation process.
Okay. And I guess if volumes continue to increase, that becomes really key in order to be able to actually manage it. So how do you see, 77% increase in the last 12 months? I can imagine that's going to be replicated over the coming 12, similar things. How do you see LuxFlag developing over the next sort of 3 to 5 years?
Well, I guess in the first instance, of course, I'm not telling you anything by saying there's a lot of regulation. So what we in the first instance have to do is to make sure that the LuxFlag label criteria are aligned with regulation. So we did that most recently for the SFDR. And then, of course, coming up next is the EU taxonomy. So making sure that our label criteria reflect the best practices, if you will, as well. And that brings me to the next point, which is Interestingly, with the implementation of regulations such as SFDR, in fact, the value of a label is becoming even more important and will be more important going forward because SFDR really is the baseline. So that going forward, or today even, any investment product that has a label, LuxFlag label, is showing that that product does more than the baseline. So that means that, LuxFlag needs to continue to ensure that, its label criteria, show added value as well. So that's our opportunity for the future.
And I think you mentioned a good point, which is the regulation will set the benchmark with the minimum, but then LuxFlag can go and help show who's doing above and beyond
exactly.
and the impact.
Exactly. Well said.
Thank you. And also, as you mentioned, the ESG label and the impact label. So I think it becomes a bit more of a sophisticated mechanism to understand where the investment is going and what impact it's making. Look, thank you so much for spending the time with us and helping us understand LuxFlag better and how you ensure that green investments are truly green and remain green.
Thank you so much, Nicolo.
Okay, well, thank you, Denise, for that interview. Now back to our panel. We've got a quick session on Q&A. We don't have that much time left, unfortunately. We've had quite a few questions in, specifically many on greenwashing and a topic that hopefully we've covered. So the one that I do want to focus in on is an interesting one. It's a recent ruling from a district court in The Hague on Shell, requesting or mandating, rather, that Shell reduce its carbon emissions by 45% from 2019 levels by 2030, I believe it was, and even instructing them to ensure a certain amount of competency in this matter on the board. So I wanted to open it up to the panelists to get your views on this. Is this the right way? Is this the way of the future, or is this overreaching? What are your thoughts? And maybe we'll start with you, Julie.
Yeah, well, absolutely. I think it's really essential for managers and boards who, by the way, are driving business decisions to understand the magnitude of the shift that's happening. Board members in the financial sector must demonstrate their skills not only supervising AML, know your customer, or MiFID regulations, but as importantly, in sustainability. And this is also valid for oil and gas companies. Ambitious sustainability goals should be defined in the boardroom. And companies that are passively watching from the sideline will clearly suffer the consequences. And I think that what we are seeing today with Shell and Exxon is clearly demonstrating this case. Because climate risk at the end is investment risk. And I think this is something that asset managers and investors have now understood and are going to hold the companies they are investing in really and truly accountable for. The market is moving fast, even if maybe still not quickly enough in a more sustainable direction. And companies and institutions all need to accelerate their transitions and deliver. And investors and customers will turn away from companies that fail to do so.
Super, thank you. And Xavier, maybe your thoughts. You had mentioned some form of sort of shareholder activism, in the early days around oil and gas companies. What are your views on this?
Well, this one is kind of surprising and not surprising. Not surprising because there is a secular trend towards, let's say, dealing more seriously with global warming, climate change alleviation, and so on and so forth. And it's fair to say that the oil and gas industry, from this standpoint, is clearly under scrutiny. Because when you look at global warming, it's produced to a large extent by greenhouse gas emission, and 80% of those greenhouse gas emissions are coming from carbon. And when you are an oil and gas company, you are obviously contributing to these greenhouse gas emissions. And this is why there is a clear call for these oil and gas companies to reinvent themselves. And this is challenging, basically. They need to amend their business model. They need really to restructure themselves. And this has indeed to start from the board. because actually the board is clearly showing the way, managing the company, not on a daily basis, but clearly showing the direction of travel. And here, basically, what the court is saying is that maybe the board has not been, let's say, efficient enough or quick enough in implementing those changes. It's surprising, though, that the court has ruled this way. I would have thought that because initially when you have problems, they come, for instance, from institutional investors advocating for change, etc., but sometimes things are not sufficient. Or maybe the legislator has, let's say, highlighted the fact that things should go faster. And it clearly shows a shift in terms of the mindset of the people. There will be less and less tolerance with the laggards. People have to change their business model, amend them, which is clearly a challenge, but also an opportunity. And for us investors, those investing in new technologies, in new techniques, in hydrogen, for instance, or it's also fascinating to see the shift in the automotive industry. For instance, there is this commitment from the US government, from the UK government, sorry, to make sure that no internal combustion engine car will hit the world in 2030, which is again tomorrow. So the pace of change will have to be extremely swift. And this is clearly showing that things have to evolve very, very quickly. That's really a necessity.
So perhaps the sign of more to come, increased regulation, more active engagement from the government in this and more active enforcement. Patrick, your thoughts in a minute, please.
Yes, I'll be brief. The one thing that I think really struck me about the ruling is actually the extent to which it speaks to the sense that we're actually all stakeholders in climate change, even people who are not shareholders in the company, people who are not investors in the company, people who may not even consume the gas and oil that those companies sell, but we are all going to be affected by this. And I think that's one of the ways the ruling sort of highlights to me the importance of actually finding ways for every stakeholder to use their voice in this whole transition, because I think it is a matter of setting very, very ambitious goals. We have to accelerate. We have to do it faster, but we also have to do it together. And I think that's what I would take away from the ruling. It's certainly ambitious. It's a lot of pressure, but I actually don't think there's any other way.
Look, a really good observation. It's a recognition of the negative externalities of a certain industry or sector that impact us all. And in that, yes, we are all part of the same ecosystem. So look, thank you very much. Julie, Xavier, and Patrick for joining us on the ESG Square, and of course also Denise for taking the time out. Let me wrap it up here. I think we've got just a couple of minutes left, so to leave you with a couple of my takeaways from this. The first, this is happening. Climate change is real. It's a massive challenge for us. There is a big demand for green, sustainable, ESG compliant products, and the growth is coming. The second is that there is a clear desire by all players to ensure that green really does mean green and remains green. Greenwashing in any form hurts everybody in this ecosystem, in the ESG Square. It hurts the banks, it hurts the investors, the labeling agencies, the stock markets, the fintechs, everybody. But more importantly, it hurts the earth, because it means we don't have the desired impact. We don't send the investments to where they really will make the biggest impact. So we're all absolutely aligned, I think, to making sure that green means green and remains green. But, and this is my other takeaway, it's not always so easy to measure and to monitor the true impact. It's a complicated problem to solve. And there are numerous assumptions which need to go into this, and that mean that conclusions can legitimately vary from, as Patrick was mentioning, being one of the top to someone in the middle to one of the laggards, depending on what assumptions you make. And so we need to go into the details of that and make sure that we get it right. I think the fourth and final takeaway is it will take time to get it right. We're all on a journey. I think the intentions are there, but it will take time to make sure that the regulations are right, that the measurement of the impact is correct, and that we get the right shade of green at the end of the day. But look, thank you very much, everyone, for tuning in. I hope you enjoyed the panel and you've enjoyed the interviews and the content. Please do visit ESG Square online. There's more interviews there, and other articles to continue to enrich and talk about this. Let's keep raising awareness. Let's keep doing our bit to try and make this a reality. Thank you very much, everyone.